Hello, looking at the annual reports of Swiber and Vallianz Holdings, you can see that there are quite some similarities between the two documents. And in fact, you just have to turn to the chairman's statements to see that similarity continue. There is Raymond Kim Goh, and not only is he the chairman of both of these companies, they even use the same photographs. Swiber owns 27% in Vallianz. They even share the same address at International Business Park. And there are other executives that are common to both of these companies. For starters, Darren Yeo, the Deputy Chief Executive of Swiber, appears here as the Vice-Chairman of Vallianz. And the non-executive independent director, Yeo Junam, holds that position at both Swiber and Vallianz. So quite a bit of crossover between the two. And if you want to know more, you can turn to page 41 of the Vallianz Holdings annual report to see all the interested party transactions between the two companies. But clearly there is an important distinction between Swiber and Vallianz. Whereas Swiber, which we've covered in another report, looks more at the engineering, procurement and construction part of the oil and gas business, Vallianz is purely focused on offshore supply vessels and other types of vessels that are required in the oil exploration and production business. They have 37 such vessels, and you can check them out in the annual report where they have photographs of them. But meantime, let's take a look at where their revenue mostly comes from. And you can see that in this chart with the blue part indicating that almost 8 out of every $10 comes from leasing out these offshore supply vessels, these OSVs, to oil and gas exploration and production companies. The last $2 out of 10, as you can see at the top of this chart, are earned from vessel management and investment. Critically, when we turn to page 12, you can see the financial highlights. And the overarching story for Vallianz Holdings is that it's a very different company as at the end of the 2014 financial year compared to 12 months earlier. The company is really you could say bulked up, both in terms of the number of vessels as well as the number of subsidiaries that it is now invested in. A little bit of debt as well, it has to be said, and it's now increasing its revenue 13-fold. That's what we've seen here in this chart. 13-fold jump compared to the previous number. And that, to an extent, has fed through to the profit number, although not quite to that extent because they've now got increased cost of sales, obviously. You can't just increase sales and not expect to have to pay more to deliver those sales, but also an increase in administration expenses. And as I've mentioned, they've got more debt, and so the finance charges are also weighing on profitability. So a multifold increase in revenue, not quite such a big increase, but still a substantial one in terms of profits. The timeline here that you'll find in the annual report shows some of that bulking up that I'm talking about. For starters, in February, they took a 49% stake in a unit in Mexico, which, as you'll see in a moment, has seemingly already borne fruit. They also won an $82 million charter in Latin America. That was back in May. Continuing on in July, a 3-year deal with China's offshore oil engineering company. And in August, seemingly went the whole hog with a unit in Mexico taking a 100% stake in a wholly owned unit. In September of 2014, they then bought a company in Batam, just across the waters from Singapore in Indonesia, Jetly Shipbuilding and Engineering, and won a further $60 million worth of contracts in Mexico. So you can see again quite a lot of activity going on to increase the size of the company and therefore to also increase the number of contracts that they've won. Let's take a look at some of the further financials, and you can find that here further back in the annual report. One thing you'll notice is that cash is up from just under $2 million to more than $20 million, and they've also seemingly been quite good about their payables, paying their suppliers a total of around $94 million, a substantial increase from payables that they that showed up on the cash flow statement in the annual report a year ago. And so how do they finance all of that, all the acquisitions as well as paying their suppliers and so on? And the answer is, as I've mentioned, through debt. We see two such mentions in the annual report. In June, you can see they issued a total of 400 million shares at 13.5 cents. Prior to that, in April, they issued 100 million Sing dollars worth of fixed rate notes due in 2016. Those notes attract an interest rate of 7.2%. But there's even more in terms of the debt that they took on. You can see that in this part of the financials. What you can see here, there is that line showing $64 million or so received from the issuance of shares, which I mentioned a few moments ago. The notes raised 123 million US dollars. Earlier on they said 100 million Sing, but that's because they raised more cash through more notes issued at the end of 2014 in December. So it totals 123 million US dollars. $35 million raised from redeemable convertible capital securities. And what's also interesting about this table in particular is that it shows that they paid off term loans to the bank worth about $101 million, and at the same time took on more debt from the banks worth almost $250 million. So you can see that there is a lot of activity on the books at Vallianz in terms of taking on more debt, paying back some of their debt. All said and done, the gearing is at 2.2 times. That means for every dollar's worth of assets, they have debt worth $2.2 or $2.20. So you can see a fairly substantial increase in debt, as you can see from this chart. And all of this at a time that the oil price, and therefore the production and exploration business, is going through some tough times. It's well documented that the price of oil fell from more than $100 US a barrel at the beginning of 2014 to only around 50 or 60 US dollars a barrel at the moment. So in this environment, obviously, that begs the question, how are their customers going about business? Have they cut back on their exploration and production? And therefore, what sort of impact is that going to have on demand for Vallianz's offshore supply vessels? Where the chairman, Raymond Kim Goh, addresses that in his chairman's notes, where he says that they still have an order book of $540 million, which is up from $470 million at the end of the previous financial year. $540 million, that figure came about thanks in part to a $100 million order placed at the end of last year, just in the nick of time for the end of the financial year, it seems. But he also goes on to say that the bid book, which is the amount of work that they're bidding for, I suppose, is at $1.2 billion. So they've got $500 million in orders, but they're actually gunning for twice as much work still. So clearly, it's a competitive industry out there, and you would expect that with a number of these operators competing for the same work, that there would be some pricing pressure. But obviously, having a bid book of $1.2 billion suggests that they're still going after quite a lot of work. Raymond Kim Goh goes on to say that the group's vessel chartering business focuses purely on supporting shallow water oil field development and production activities. In other words, areas which the oil exploration companies can get to more easily. Therefore, they are likely to be less affected given the lower break-even costs compared to projects in deep water oil fields. So perhaps that will be of some benefit and will boost the chances of getting some of those contracts. He goes on to say, moreover, the group serves primarily national oil companies which tend to have less volatile exploration and production spending patterns. In other words, they'll keep producing and keep investing in exploration even when the oil price is down. And at the same time, finally, the group aims to diversify its geographical presence by increasing its penetration in other major and emerging offshore exploration and production markets, and he singles out the Asia Pacific, Latin America and West Africa for those. Full details in the Vallianz Holdings annual report.